Hello and welcome to a brand new show of Market Makers. Our guest on the show today is none other than Rashesh Shah, Chairman and Vice. Rashesh, welcome to the show. Good to have you back on ET Now. Let me start the discussion with the obvious question, which is Reserve Bank of India rate cut at a time when global growth is anemic, commodity prices are high. Do you think Reserve Bank of India has taken a gamble by front-loading such a big rate cut?
I think in a way it's a good thing because when they were hiking rates, they were taking small steps. But I think while cutting, I think given that the growth concerns are becoming fairly strong and Indian growth has slowed down especially, and I think interest rate it obviously affects cost of capital, but psychologically also it's a very important indicator. So I think in a way Reserve Bank has given that boost to the market and said instead of doing small cuts on the way down, we might as well do fairly big one, and it surprised the market in a very positive way. So I think on the whole it is good. We still don't think there will be a lot of rate cuts in this year. I think if we get altogether 75 to 100 basis point, out of which 50 has already come, I think it will be good. I think our estimate is about 100 basis points for the year is what we will get, because inflation will stay around 7. We are hoping it won't go up if oil prices are not going up, but it won't come down in a very big way also.
Let's talk markets now. For the financial year FY12, Indian markets, the benchmark indices were down by about 9%. Do you think this fiscal we will be able to recover much more than what we lost last year?
I think the first half of this year we still see a sideways market with fairly high volatility, because I think all over the world government actions and the regulator actions are actually directing the markets. I think fundamentals people don't have as much confidence, but if the European Central Bank announces an LTRO3 or a QE3 or something like that, I think it does affect the market a lot more. So as long as the markets are still watching government moves and the regulator moves, we will see high volatility with some kind of a sideways market. Our expectation is that Indian economic activity, which has started creeping back, if we have altogether maybe 100 basis point rate cut through the year, and I think our current account deficit is coming back under control. Given all of that, maybe second half of the year we might see positive uptick in optimism, in corporate earnings and all of that.
So what are the data points you're mapping which is giving you the confidence that the economic activity or the on-ground economic activity could pick up momentum?
See, if you compare the key things that had gone against India in the last year, there are about 4 or 5 of them. I think the current account deficit had gone up. We are close to 4% now. It did affect rupee. Rupee had also come down. Interest rates were increasing all through the year. Liquidity was very tight. Fiscal deficit was going up, and government was crowding out other borrowers, and there was government policy paralysis and all. Now on all of them, except maybe fiscal deficit, on all the others there is some improvement. Interest rate cycle has at least started to come down. I think gold imports and all have come off a lot. If the oil stays here or oil comes down a little bit, we will see some relief on the current account deficit also. I forgot to mention in last year we had no foreign inflows, FIs. We already got some FI inflows, which is good for the rupee. I think even policy-wise some action is being taken, and I think the government is now becoming cognizant that we can't have another calendar 11 in front of us. So I don't think there will be a huge rash of announcement, but I think some action we'll see in a few sectors here and there. So if I look at all of this, if the economy was at -8 in the last year, at least that -8 has become -3 or -4. So there is an improvement that is there, and as the year goes by, I think also we should remember, Nikunj, last year we came with very I think reasonably high expectations, because India was still everybody is watching our growth, and we all thought this was a small blip. It was a correction and all. If I go back to April 2011, now I think expectations are so low, and in the next 4-5 months, if the economy is sideways, if the interest rates cuts are not coming as fast as people were hoping, all of that will bring expectations down, and when expectations are down, usually positive surprise on the upside can happen.
But what about global liquidity? And in last 15 days, we've got not one but 2 reminders. One, comments from ECB, president, that only thing which is growing for European economy is risk. And second, the failure of Spanish bond yields, which is some kind of an indication that the LTRO magic or LTRO2 magic is now fading away.
Absolutely. I think LTRO was very powerful, and I think what all the regulators are doing is basically, I don't think the actual disease is being cured. They are just providing relief on an ongoing basis. But for India, as long as the relief is ongoing and there is a lot of liquidity floating around, because I think what has happened, all the regulators have realized that every time the disease gets worse, you need to inject liquidity. As long as that keeps on happening, I think for emerging markets, for India, there'll be a sense of relief, because I think interest rates are low globally. They'll continue to stay here. So if India can benefit out of that liquidity, because I think our capital needs are there, it won't be bad for India.
I remember this conversation we had on the same forum, and that time about a year ago, you had indicated to our viewers that there is global liquidity and it is time to buy commodities. But now your view is that there is global liquidity, but it is time to sell commodities. Why is that?
I think for a simple reason that global growth has slowed down. China was one of the biggest factors in commodities. A year ago, we all were fairly confident China will continue to grow at that pace. Now I think we are seeing that China is slowing down. I think you used to remember, Nikunj, if India and China, our growth rates are down by 200 basis points each. If everybody thought China will grow at 10%, now everybody is saying 8%. Everybody is saying India will be 8.5, 9, now we are looking at 7. If when you take India and China and take 200 basis points of growth away from these countries, and then you have the Eurozone that is not growing, and it has been clear in the last 1 year, I think if you take Euro, China and India and you slash this 200 basis point of growth, the demand for commodities have to come down. So I think the only reason commodities will go up is the excessive liquidity that is there. Because if the US market is not doing well, the European market is not doing well, emerging market is not doing well, then the excess liquidity all goes into commodities. But I think given that the US market has started to do well, it has the absorption capacity, so our view is that commodities have got overpriced, and you will see a switch back from commodities to maybe equities all over the world.
As of now, the basic building block of this year's market rally is liquidity, which has surprised us on the upside. Do you think now earnings could surprise us on the upside, or you worry the course Q4 earnings and then finally FY13 earnings could take?
See, I think the great thing that in the last 3 years we have seen about liquidity is liquidity now affects everything. Earlier we used to say there is sentiment, there is liquidity, and there is earnings. In the short term, sentiment matters, in the medium term, liquidity matters, and in the real long term,
that's a proprietary line.
Earnings matter. But what we have seen in the last 3 years, Nikunj, is I think liquidity is affecting sentiment. I think liquidity is also affecting earnings. So I think now we are in a new world overall, and I don't think the world has seen this kind of liquidity injections ever. So the good and bad of this we don't know, because some new experiment has been tried globally. But I think currently liquidity drives everything. So will earnings go up because of liquidity? Absolutely, because liquidity will bring cost of capital down. It will I think allow companies to grow. So on the whole, I think liquidity will affect earnings. But I think in India, we will have to wait for the second half for that to happen. It won't happen in the first half.
Since liquidity indeed is dominating this discussion as well, and if you're of the view, which you are, that liquidity in coming quarters will remain rather cheap, strategically, which are the asset classes which tend to outperform if global liquidity will remain cheap?
I think it's an important point to make, because I think global liquidity will be cheap. Indian liquidity will not become cheap very fast, because Indian inflation, I think RBI has also said we will stay at 7% inflation. I think 7% inflation, 7% growth, you should not expect Indian liquidity to become cheap very fast. It will be cheaper than what it was a year ago, but it won't get very cheap and very easy very fast. So you will have global liquidity which will help some of the asset classes in India, and I think the asset classes that it will support will be, according to us, I think equities and real estate, because a lot of global liquidity is flowing into real estate in India via the private equity funds and the structured deals and all of that. And I think it is also flowing into the equity markets. That's why we are seeing equity markets are still fairly stable in spite of the doom about India and the policy paralysis and all those things that global media, everybody is talking about. Indian markets are still fairly stable. And I think it is largely because of global liquidity. So these two asset classes will do well. What will happen in India is actually the opposite. The companies which are not capital intensive, or industries which are not very very sensitive to availability of capital and cost of capital will be the ones which will do well. So I think at a company level, specific level, you want to avoid, I think even now, highly capital intensive companies. But I think at an asset class level, the global liquidity will have equities and real estate.
The India romance is consumption. That's where the money is, that's where growth is. But consumption stocks are expensive. And just to give you a P number here, Nestle is now trading at 35 times based on FY13. So these are great companies, but are they good stocks to own?
I don't think any more. I think they're safe stocks to own because consumption now provides you not great value for money from an investment point of view, but it's safe.
These stocks are making a new high every year.
So it's safe because I think everybody is piling onto that. So I think you won't make a huge amount of returns on buying consumption stocks, but you will protect your downside. So I think what is happening is a lot of investors are flocking into these sectors because they want safety, because you still don't know how India recovery is going to happen. Our view in Edelweiss is we will see recovery in the second half, and when that recovery happens, I think some of the other sectors like banks and auto and all will do well. But until then, I think currently the money is looking for safety. I think our advice to investors has been that you should not go where everybody else is going. You should try and find the new emerging, I think, investment opportunities where stocks are cheap, and if your hypothesis is that there is recovery in the second half, then you might want to look at a lot of these small cap, mid cap companies if you have a 3-year horizon, because they are starting to show some strength, and this interest rate cut will help them a lot.
What about other alternate asset classes, fixed income, gold, and then Indian real estate?
I think fixed income is obviously, I think, an easier one with this interest rate cut cycle and all, but I do think the fixed income market is fairly efficient and it has already factored that in. So you should get yield on the fixed income. I don't think capital appreciation, you will get a huge amount of capital appreciation in the fixed income market. But I think from an yield point of view, it's a good market because interest rate will not go up, so you won't have any capital erosion in that. But you will get yield. I think depending on whether you buy corporate bonds or whatever, you get 10-11% yield on that. But you won't get a huge amount of capital appreciation. So I think our advice is on fixed income, expect between 10 to 12, 13% returns. Equity, you should hopefully get 15 or so, especially in the second half. And if you are smart in this half, and I think invest smartly, you should get a good upside. Gold, we are not very optimistic because we think the gold cycle has started to play out. The world is not looking for safety anymore, because I think that a year ago gold was a safe haven, and I think consumption of gold has gone down. I think India's imports of gold will be down 25 to 30% in the coming year is our assumption. So if India's consumption goes down, I think global gold prices will also not be as robust. And I think real estate is a good, but it's not easy to make investments in real estate because of liquidity and all. But I think except for here in Mumbai, I think real estate prices in India have softened. I think some very good opportunities are available. So if you're buying a house or you're investing in property, in office, commercial and all, it will be a good year. Especially when interest rates are coming down, you will be able to get access to cheaper capital.
So you're bullish on Mumbai real estate prices?
No, what I'm saying is Mumbai is still slightly more expensive than what it was historically, but all India correction has been fairly sharp. If you go to Gurgaon and Noida and Chennai and Bangalore, I think I think reasonably good investments are available. I think even in out here in Bombay, if you go outside of the island city of Bombay, I think there are some good investment opportunities, because I think real estate is a fairly robust market, and I think Indian real estate for the next 8-10 years should not have a problem of consumption.